The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Is it a sell-off or is it simply a rotation? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Pretty thin trading here, so I don't know how much you can read into today's market.
It is mid-August, yeah.
It is mid-August.
Yeah.
All right, let's take a look. You have the S&P 500 down for a fourth day, losing 0.5%. Ditto for the Mag 7, which, by the way, is down about 3.6% during this four-day stretch. You do have yields coming down, but just barely lower. After the latest Fed minutes show, policymakers still remain very concerned about inflation. And NYMEX crude up about 1.4% after an industry report showed inventories declining last week. Romaine?
I know we shouldn't make too much of it given the seasonality here, but we talk about the concerns out there about overstretched valuations in big tech, all coming at a time when the Fed may actually not be able to deliver the rate cuts that the market had priced in. That's a big part of the reason why you're seeing the declines on the day, a two-day drop in the NASDAQ 100 that potentially could be the worst slump since the post-Liberation Day sell-off in April.
It does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells. No reason to think there'll be a correction soon. But the point is that things are expensive.
Nothing nutty out there, but Goldman's head of hedge fund strategy, Tony Pasquarello, in a note saying that the market moves now actually reminds him of the riveting summers back in the late 1990s. That's when markets notched those improbable record highs amid super low volatility against the backdrop of super high expectations for rate cuts that they wanted to see to prevent economic cracks from widening into a recession. Good luck with that. The Fed minutes from the latest FOMC meeting dropped an hour ago, and it did show officials do see inflation risk outweighing labor market concern, and likely for a good reason. Nike, Sonos, P&G, just some of the companies that have been mulling raising prices to counter tariff costs. Home Depot yesterday flagging price hikes are coming. Sony today said its price hikes are here, boosting the sticker on the PlayStation console by 10%, Scarlett Fu, $550.
What are teenage boys going to do?
I don't, and you know,
and
older men.
Grown men. All right. So a lot for investors to grapple with. And Romaine, you mentioned the NASDAQ 100's worst slump since Liberation Day. Even within technology, it's really a handful of names that are doing the most damage. Mega cap tech stocks driving the AI narrative. So this bar chart looks at the difference between the performance of the NASDAQ 100 and an equal weighted NASDAQ 100. And you can see today's deficit, this red bar right here. It's of 1.34 percentage points. That is the most that's going back to mid-April, which really underscores the idea that there is a bit of a rotation out of the winners, those mega cap tech names, into other companies and other sectors.
Absolutely. You certainly see that in some of the factors here on this day. Let's bring Jeff deGraaf into the conversation. He's the chairman and head of technical research at Renaissance Macro Research to kick us off to the close here. And Jeff, I think Scarlett's last point really kind of hits at what might actually be going on underneath the surface here. Some of the high beta names being sold, but you're seeing low volatility stocks get bought, dividend yielding stocks get bought. What are you seeing in your data?
Yeah, that's exactly right, Roman. I mean, if we go back to April, we had beta in our work, at least, in the 0th percentile in terms of returns, and it's a fairly consistent mean reverting series, right? So there's really no persistence in high beta versus low beta. It just kind of oscillates and the pendulum swings between good and bad. That went from April in the 0th percentile over the last 30 years to the 100th percentile in mid-July. And at that point, we started warning clients that beta was just extended and it was likely to revert and cause some agita. Clearly, we're seeing that now. So I don't think this is a market problem. I don't think this is a valuation problem. I don't even really think it's much of a sector problem. I think it's a factor problem. And regrettably, we went from the 100th percentile to just yesterday in the 93rd percentile. So even though that factor, that spread has lost about 15% here, it really hasn't contracted enough to say that all's clear. So I think beta is going to be under pressure probably for the next month to 2 months. I think there's more pain to go there. I don't think it's a big problem for the S&P. I think you're going to see more rotation. And we've been urging clients to swap out of beta and towards higher momentum names. There's a little confusion around what the difference is, but basically think about beta as volatility, think about momentum as price trajectory.
So, well, I'm glad you make that distinction here. So let's talk about those momentum stocks, or at least those ones with that price trajectory, because there's been some concern that price trajectory might have actually topped out. That doesn't necessarily mean we're going to see a mass sell-off in some of those names, but the idea of how much further can they go if there isn't some additional support either from corporate fundamentals or macro conditions, which are all kind of intertwined.
Well, that, and you have seasonality too, right? So I think part of that is you've got a weaker September historically that tends to bleed into October about the first 2 weeks. And, one thing that gets underreported or underappreciated is we still have a risk, albeit slight, of a potential government shutdown to fund the fiscal year 2026. And so, while Congress is out right now and there's a bunch of noise, in Texas, obviously, with what's going on, there's also a risk that they come back in, early part of September and make a united front against funding. And so I think there's some things on the horizon that could obviously be some pitfalls for the equity markets. Even if that doesn't come true, just the rhetoric is probably enough to do it. And when we look at the option market, you're not seeing any of that priced in. You did see the August 1st tariff deadlines priced in with some backwardation in the options market. You're not seeing that for the potential for government shutdown at the end of September. So I think that's just something for investors to keep on their radar here.
Okay, so there's a lot going on here, but as we look at investors sell off some of the winners from the past couple of months, how much do you really read into the sell-off of tech stocks here? We make a big deal about this 4-day losing streak in the S&P 500, the biggest 2-day loss since the post-Liberation Day sell-off. But aside from rotating into other lagging sectors, do you see anything in there that really is cause for concern?
Well, it's a really good question. And, I was on vacation 2 weeks ago and I came back and I really try to disconnect when I go away. That's not always that easy. But I came back and the first thing I did was just run through charts, right? I run through every Russell 3000 chart. And, for the first time really since the spring, I was finding a pile of charts that were shortable. These are names that had cracked. They rallied. They kind of failed anemically up to their 200-day moving average, and we're now rolling back over. So it was the first time in at least 6 months I had seen a substantial number, albeit not a majority, but a substantial enough number to say, hey, there are some fissures here. And I think that those are important. They are in software. They are in semiconductors. There's some in discretionary. There's some in industrials as well. So I think this is a more balanced market. I think you see that in the percentage of issues above their 20-day moving average, which is running at right around 50%. So half the market's above their 20-day moving average, half the market's below their 20-day moving average. And I think that's exactly the recipe for consolidation. Again, not a big correction. I think it's probably less than 5%, but I do think there's a consolidation in the works here.
Yeah, that's really interesting how many companies you found that kind of fit the bill. When you talk to clients, what is the number one question they're asking you right now, Jeff?
Why are my momentum names getting killed? I mean, I've been on the phone this morning with clients, and what's interesting, you can even use the Bloomberg function FTW and look at the Russell 1000. Low volatility is absolutely trouncing everything else today, but importantly, momentum is also up, albeit slightly. At least it was before I came on, which says this really is more about beta than it is momentum, and so I think that's a really important distinction, that people are kind of bleeding into momentum when it's really beta that they want to be talking about. And that is an important distinction because it will make a difference in portfolio, not only construction, but performance as we go.
I am curious, Jeff, when we talk about the potential downside scenarios here, a lot of people, of course, are looking at some of those key moving averages and seeing if we retest them. Well, yesterday, we had Jeff Jacobson on, and he was talking a lot about his most recent note about a lot of the put buying activity that he's been seeing in the market. If we do start to hit some of those technical levels, do you have confidence that we'll maybe see that as a dip buying opportunity, or could that really presage maybe the start of a further decline?
No, I have a lot of confidence that it's an opportunity to buy on a couple fronts. One is, if you look at credit markets, they're incredibly placid right here. You could say maybe too placid. I mean, I don't think there's a lot of value there, but certainly the implications for what it is suggesting for the economy is bullish, and I think that's important. You usually will see deterioration in the credit markets before there's a more meaningful decline that we have to worry about, and that's just not happening. And I think the other thing that's being underappreciated here is just how strong the global economy is and what's happening globally, at least in equities, maybe not the economy, that's not my call. But if we look at the equity markets, particularly in, say, Asia, You're on the cusp of breaking out Hong Kong. You're on the cusp of breaking out China. You've got Japan, which just made a 35 years, as long as I've been in this business, new high on the topics. So there are things happening, on a global basis that you'd have to believe that the U.S. is somehow the sick man in the globe. And I just don't think that that's true, given what we're seeing out of credit. And the other part, just to maybe punctuate that, is what we're seeing out of financials. And financials are still, if you risk adjust the trends of financials are still leadership. There's still a lot of good bullish trends there. And that's just not something that you'd expect to see, or we'd be prepared to see as a market is about to become more vulnerable and enter a bearish phase. So I think there's a lot of things that are actually supporting this underneath. It was just a matter that beta got extended, and I think we've got this consolidation that's going to help to kind of clear that away.
All right. Well, a really sobering conversation here, particularly coming from a guy who's seen plenty of market cycles. Jeff, always a pleasure.
Are you calling me old? You're calling me old.
I'm calling you seasoned. Jeff deGraaf, chairman and head of technical research at Renaissance Macro Research, as we continue our march to the close with a closer look at the state of the consumer and a closer look at the state of retail. A conversation up ahead with fashion legend McKee Drexler.
Can't wait to talk to him. Plus, critics continue to sound the alarm on the administration's tariff rollout plan. Trade expert Manak from the Council of Foreign Relations here to weigh in.
And we're going to talk about the services industry as well. The bowling giant Lucky Strike making some changes to get people back in the door. That conversation coming up a little bit later as well. Stick with us. This is The Close on Bloomberg.
President Trump calling for more resignations at the Federal Reserve today, this time with his accusations directed at Fed Governor Lisa Cook. The allegations stem from a letter written by Federal Housing Finance Agency Director Bill Pulte that claims Cook committed mortgage fraud in attempts to acquire more favorable loan terms. All of this as the Jackson Hole Economic Policy Symposium kicks off tomorrow. And that is exactly where we find Bloomberg's Mike McKee. So, Mike, Lisa Cook is supposed to arrive at Jackson Hole for the symposium. How much of a cloud does this kind of cast over the proceedings?
Well, obviously, it casts a cloud because it expands the political vendetta that the president has had against the Federal Reserve for not lowering interest rates. It was Jay Powell in the crosshairs, and now it's Lisa Cook, who is not a particularly influential monetary policy member. She votes with the majority and generally supports Chair Powell's decisions, including to keep interest rates on hold for right now. But converting her one way or another wouldn't make a difference in the overall vote, as the minutes showed just a few minutes ago. So it isn't clear exactly why they're doing this, other than the possibility of, if they could force her resignation, the president would get to name another member of the Board of Governors who would presumably be more supportive of his policies.
I'm glad you brought up the minutes, because normally we kind of overlook that. But I did think it was interesting that the ones that just came out about an hour or so ago really did talk about this idea that there is a lot of concern about inflation really maybe being the more preeminent concern than the labor market. And I'm wondering if you could kind of fold that in, combined with the pressure that the White House has been putting on various Fed members, and what that means for Jay Powell's speech scheduled for Friday.
Well, I think Powell will try to stay away from politics at all costs, but he does have a balancing act. He doesn't want to get the markets locked into a rate cut for September, because we don't know what the jobs report and the CPI report for August are going to look like. When these minutes came out at that meeting on July 30th, we'd had a very strong July jobs report, the one that was revised lower this month. And we'd had a CPI report that only showed the glimmers of inflation from tariffs. Now we've seen more tariff inflation coming through, and the forecasts are we're going to see more, which is what Fed officials were looking at in July. You get a weak employment number, or you get a higher inflation number, and those are two conflicting sides of the mandate, and they would call for different monetary policy responses. So you can see why Jay Powell may want to keep his powder dry and not let anybody get too far off the reservation on thinking the Fed is necessarily going to cut, just in case we get a really hot inflation report.
Right. So in that way, you could argue that the Fed minutes perhaps may set us up for a hawkish surprise on Friday from Jay Powell. It's not just Fed officials, senior Fed officials, who will be attending Jackson Hole. You also have global central bankers there as well. How much are they likely to comment on the whole idea of central bank independence?
Well, the idea of central bank independence will probably get a mention from some of them. They sort of want to offer support to Jay Powell. They did at the ECB meeting in Sintra, talking about the fact that central banks that have independence to make policy decisions generally have better functioning economies. But they won't mention Donald Trump, and they won't mention the specific controversies that are going on here because it's not their business. They would stay out of that.
The final question, Mike. I mean, there's been a lot of talk about the Fed framework. Of course, the one that they kind of put out there was like about 5 years ago, the potential update of that and whether we could potentially see a meaningful change to it. What is your expectation, and do you think they will allude to that here at Jackson Hole?
Well, the expectation has been that Powell would kind of lay out the contours of the new framework. He did that here in 2020 when they first adopted the last one. And it's obviously got to change because at that point we saw inflation that was very, very low and had been for years, and unemployment was continuing to fall, and they felt that they could let the economy run a little hot without risking higher inflation. Then we got the pandemic, inflation shot up, they were slow to react to that. So it's clear that framework didn't work. More likely they'll go back to something like they used to have, where they basically are telling the markets, we'll do whatever we need to do depending on which way the economy develops.
All right, Michael McKee out there in Jackson Hole, Wyoming, keeping an eye on the Fed's Kansas City Economic Symposium. And of course, a big speech by Jay Powell set up for this Friday with yields down a second day here on this Wednesday afternoon. Meanwhile, we turn back to the equity markets and take a look at one of the biggest decliners on the day, and that is Target. The shares having their worst day since April 8th after its earnings report and a, well, largely expected change in its leadership. Joe Feldman of Telsey Advisory joins us after the break. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off today with Avis Budget Car. Bank of America double downgrading to underperform from buy, concern about limited pricing power that could further ding the rental car company's fundamentals in an already unsupportive macro environment. Those shares down about 6% here on the day. Next up, let's take a look at General Mills. JP Morgan out with a broad note on the precarious state of food companies. It downgrades the Cheerios maker General Mills to underweight amid dour grocery aisle trends, market share losses, and rising costs. Those shares down about 0.4%. And finally, Abercrombie and Fitch, Citi cutting to neutral, saying specialty apparel retailers, well, they're going to have a tough time passing on tariff costs to the consumer. Abercrombie shares down a second day, 3.5% to 91.59. And those are some of our top calls. We want to stick in the retail and consumer space, and that brings us to Target. The shares having their worst drop since early April after missing the mark on its full-year outlook, and the announcement that its COO, Michael Fidelki, is going to be the replacement for CEO Brian Cornell. Joining us right now is Joe Feldman over at Telsey Advisory to talk a little bit more about the change. But before we get to the leadership change, I do want to ask you a little bit about the numbers themselves that we got from the past quarter and whether what's ailing Target is specific to Target or whether it's wrapped up in the broader macro issues.
Well, it's a terrific point, Romaine, because, Target sells a lot of discretionary goods. Discretionary goods are not selling as strongly these days as non-discretionary. So the companies that have more exposure to groceries, consumables, household basics, and everyday essentials, those areas are doing well. And actually, if you look at Target's business, it did okay in that category in food and beverages and held up okay. But the discretionary side of their business, which is really about 62% or so of the business, is really where they're seeing some pressure. Where they saw newness and brought some innovation to some of the product in the discretionary side, customers did respond. But some of it is the mix of what they sell. But there is still some issues at Target. I mean, clearly the stores are not as tidy as they used to be. It takes a long time sometimes to get through, to process through checkout. The stocks don't always have, or the shelves don't always have the stock that you want. So there are some issues that they do have to work through.
So my question here then is, by picking an internal candidate rather than going outside and choosing someone from who doesn't have the legacy and therefore the burden of what Target always represented, How much movement is there likely to be? I mean, how much can he really move the needle, the new CEO, on improving the execution of what's already been laid out?
Yeah, that's a great question, and I think that's reflective in the stock today as to why it's down. I mean, I think a lot of the investment community that we speak to on a day-to-day basis has been frustrated or is frustrated today and was worried that they may promote Michael Fidelki. He's the COO. He's been there at the company for 20 years. He's been part of the strategic planning group, and he's responsible for executing the strategy in the stores from an operational standpoint. So I understand the concern. Sometimes when you're the boss, though, you can make changes. You may be able to execute things a little bit differently. Perhaps that's the case. I think people should give Mr. Fidelki a chance to see how he does in this new role, but I understand the skepticism, and I have it myself. I mean, I think there's definitely some concern there. And maybe a different change catalyst is what everybody wanted. I think the investment community wanted to see a change at the CEO. But again, reflected the stock today, they're not that happy with it.
Joe, I am curious about some of the, I guess, politics or cultural issues that have popped up around Target, whether it was the controversy over some of the merchandise it was selling to appeal to certain minorities, the pullback away from that, given some of the pressure on DEI from the Trump administration, and whether the anecdotes about that affecting its sales and profitability was actually real, or was that just something in our heads, something the media trumped up?
I think it was real. It may not have lasted as long as some people think, but in the first quarter, they definitely saw some pressure related to the change in their DEI policy. There were some boycotts. There were some people not shopping at the stores as frequently, and you saw that in the traffic numbers, or transaction numbers as they count. But this quarter, it got a little bit better. Still down from a transaction perspective. So traffic, in other words, people visiting the stores, was down. But I think that was more isolated to the first quarter, but we've seen it before. We saw it back with the Pride issue that they had a couple of years ago. And, Target is the company, because it's such a large, popular retailer that has a lot of passionate, loyal shoppers. It evokes a response from people stronger than many other companies.
That's a great point. Joe, really appreciate your joining us. Joe Feldman is Senior Managing Director and Assistant Director of Research at Telsey Advisory Group. Coming up, we've got the retail legend McKee Drexler joining us live in studio to talk about today's full cart of retail headlines. That's next. This is Bloomberg.
3:30 p.m. here in a rainy New York. This is the countdown to the close for, rains over the market. I'm Romaine Bostick.
And I'm Scarlett Fu. A slow market day, but there's so many headlines, especially as it relates to the retail sector.
Yeah, I mean, this week and next are really big, where we kind of really get a read on the health of the consumer, not through the official economic data, but through the corporate earnings.
Through the anecdotal. And, the big question mark here is the tariffs are finally in place. So how much is that really discouraging consumers from going out and spending?
Mm-hmm. Well, so far, I mean, it's kind of a mixed bag, right? We heard from Home Depot. They said people are spending. The problem is they're spending on smaller projects. And you have other companies that also showed an increase in spending, but some of that was also because of the increase in prices. And there's a lot of stories that we're tracking on that front today. I mean, we came into today and there was a big headline about Guess. Do you remember them?
I remember Guess. I remember Guess from the 80s and 7th grade and $50 jeans.
Well, they're a public company, but they're now going to be taken private in a $1.4 billion deal with Authentic. You had TJX Companies report earlier this morning. It was good. You had Estee Lauder reporting earnings this morning. They were bad. And then, of course, you had tariff concerns like Scarlett was just referring to, really weighing on names like Gap, like Abercrombie, and, to a smaller extent, like Target. So a lot to talk about here, and who better to talk about it with than one of the kings of merchandising. McKee Drexler is the chairman of Alex Mill, and of course, he's probably most well known for helping to really reinvigorate and turn around J.Crew, and of course made Gap what it once was, and maybe what it once be again. McKee, great to have you.
Nice to be here.
And happy belated birthday, by the way.
Thank you very much.
You have been doing this a long time. You understand consumer trends.
Well, I understand, not always. I've been doing it. I've practiced my craft for 50 plus years.
50 plus years.
Repetitious.
All right, you don't have to be modest.
No.
But one reason why we love having you on is because when we talk on the show about the health of the consumer, we always look at it through the economic lens. But there are a lot of other factors that determine what we buy, how much we're willing to spend on what we buy, and then, of course, whether we continue that. When you look at the state of specialty apparel right now, what does it say to you?
Well, I'm a tough critic, first on myself and then on everyone else. I think the specialty, and it's really, I would group all retailers in. I think the days of kind of merchandising-centric, pick the goods. You know, I have a little hobby of listening to founders of great companies, reading articles, et cetera, et cetera. And you know what words appear almost on everyone? Enzo Ferrari, Steve Jobs, the Michelin brothers. The common thread, instinct, gut, and intuition. Because you can't run those companies. And of course, I watched Steve for 16 years. And that's what, to me, that's the business. I think it's true in any business.
Yeah.
So when I look around and, you know, God.
But instinct, gut, I mean, not to belittle that, but that seems a little bit more esoteric.
Totally.
Particularly in a time where we're dealing with very real-world issues, economic pressures, tariffs. I mean, you know, just being able to source goods at this point right now is just mind-boggling. Not just the cost, but just not even knowing what the tariff rate you're going to pay today versus tomorrow. So how do you do that?
Well, I don't. The esoteric. You know, you have to put. You know, as an artist, a great painter, esoteric, designer. I think esoteric, whatever it actually means exactly.
I'm not sure what it means.
You know, but it's a qualification in the creative world and in the merchandising world. How do you know if something's a bestseller or not? You know, AI will not pick colors. It will not tell you what's a bestseller, and ... And of course, it'll probably eliminate a number of jobs. So I think the world underestimates that. I was listening this morning to. I do my rehearsals for this show. Bloomberg, CNBC, sorry to say, and whoever the other one is.
Never heard of them. Yeah, sure.
And it was interesting how the fellow who was the guest, a guy who's been in the retail business his whole life, retired, was talking about Target and saying about a financial person, and there's nothing wrong. Look, I could never be a CFO in my life, but they were saying Target used to be, my word, Target. What do you need to run that? And the numbers don't create the products. And it's kind of like, look, I couldn't be an accountant, and I couldn't be a chef, but if you put the restaurant's accountant as the chef, it's no different than you need merchants.
Right.
And this guy was saying it, and I'm going to get in touch with him because I don't know his contacts.
Yeah.
But it's kind of a misunderstood concept in a way.
Right, right. So let's follow on that, because Romain named a whole bunch of companies and said one of them that did do well is TJX, and they have this incredible business model where it's off-price goods catering to a high household income.
I
customer.
idolize her, Carol.
Tell me more. Tell me more
What
about
you
that.
say, but from what I looked at, they were 4 comp and 10% increase in earnings. We do business with them, and Carol, long term, and she doesn't like me to praise her like this. In fact, I'm seeing her this weekend for a coffee.
And you're talking about Carol Meyerowitz, the chairman.
She's the best, and she's a merchant, and she's a wonderful person, and she knows who she is, down to earth. But they buy the goods from all the places who they're biggest customers of the wholesale brands in a lot of cases, and the wholesale brands sell their goods to their department store retailers, and they kind of pay for markdowns. Her prices are the real prices you see.
Right.
You go into TJ Maxx, and that's the price.
So is that a case there where they just have a really great business model, or is it that they have exceptional execution? Which do you give credit to?
Well, any great business model is dependent upon the great leader of that business. And TJ Maxx has always been, they buy the goods from all of us. They negotiate like crazy, and they put it out at a price. And they don't have Assistant Buyer's Day or, you know, Prime Day or whatever. It's a very honest model. And that's, look, what, 50 billion, 60 billion, whatever. But I'm curious, and we don't have time for why it wasn't a good report. But anyway.
Yeah, well, yeah, but it gets to this idea, though, too. I mean, their model has been resilient, and we know that.
Yeah.
But it decidedly was always supposed to be a value model. For those companies that maybe didn't have that model, so you take the Gaps and the Abercrombies and all of those names there, all of those companies at one point in their history have fallen victim to that sort of perpetual discounting.
Well,
that was
there's still a group of them that's in that same.
There are. Some have managed to try to wiggle themselves out of that. But I am curious as to how you do that. If that wasn't your model to begin with, and you have found yourself trapped in that, how do you get out without simply going under?
Reinvent, move forward, imagination. I mean, for me, I never thought about the answers to that, but I always lived in my imagination, and I always was very critical, but I learned from the best in the business, and not the retail business. I mean, I'm learning about these founders, extraordinary stories.
But it's not always the founders. I mean, we talk about, and we can go down memory lane for a quick second, so just bear with me, Scarlett. But I mean, we go back to the late 60s, early 70s, when the Fishers founded Gap, which was basically just a reseller of jeans and records and other stuff. Some point, I don't remember the exact year, you come into the picture and you completely reimagine what they sold, from very colorful, a wide variety of stuff, to basics, simple. But with the that was you.
Color was the #1 ingredient that was part of the concept.
Oh yeah.
Gap, when and all due respect to Don, who helped me in my life.
Sure.
Gap was a discounter.
Okay.
It was pure discount. It was started as a Levi business. Gap was discounting Levi's when I got there, 2 for $26 or whatever. I went to Houston Galleria. I said, what did I get myself into? There's, on the windshields, there's these, what do they call those little things under the windshield?
Yeah, the flyers, yeah.
Flyers. I look at one where today only, Gap 30% off. It was a nightmare. But I didn't say, oh, I'm going to reimagine it. It was inside. You have a vision. I used to live in my imagination as a kid for a lot of other reasons. But and a lot of founders, by the way, and Don knew this, when they hit a wall I got there in 1980 or 83, he knew. I mean, there was 2 or 3 people. No one could do the job. You imagine it. Old Navy was an imagination. Came from Old Navy, named after a bar in Paris.
So
weird.
Who is out there right now? What company is out there? What merchant out there is doing that imagining, is getting people excited about their specialty apparel?
Well,
Who do you admire?
The customers would answer that better than me. I am so critical of me and everything we do. You can ask my team, they call me the pain in the ass. That's what they did. They did an email or whatever. I don't know if you can put that on the air, but
well, it's live.
Who's out there? I respect companies that build great businesses long term, and you don't turn around a company in a year or 2 or 3.
Well, but I'm curious, though, on that point, because I think the last time we were here, we talked a lot about kind of the reemergence of Abercrombie and Fitch, certainly in terms of its stock price, its revenue. Just earlier this week, Bloomberg did a great story talking about some of the progress that J.Crew has made in turning itself around.
I want to see the numbers. Go ahead.
And I know it's still early, and I want to be fair to the CEO over there, Libby Waddle, and what she's doing. But I am curious about when these CEOs, and whatever their background, are trying to turn around these companies. Why isn't sort of the MBA, the CFO, the CEO types not necessarily the ones in your mind that can do that best?
Yeah, it's an art and a science, this business. And Libby and I worked together for 15 plus years at Gap and J.Crew. She's terrific, but I always ask the customer. I work for customers, and I go into all of our competitors. I schmooze with the salespeople. Well, at Gap and J.Crew, I know a lot of people, Madewell, Old Navy, but you have to find out from the consumer, and I have a judgment I make. Like, I hate to say, the car industry I look at today, and I'm an old guy, been around a million years, and I like nice things, forgetting the Bronx, which taught me all that. But if you look at the car designs today, where are the great classics? You look at, I mean, designer clothes, it should only happen to us, but the consumer has changed. Logos, forget about it. And the fakes, it's not so prestigious to carry some fancy Dan
That's
hand.
right. Well, consumer tastes have changed, especially with Gen Z, and we see that in what they think of as stylish. I mean, there's a lot of what's popular right now is stuff from the 80s or 90s, and concert band T-shirts are seen as a brand in and of themselves. What are customers telling you really when you look at the customer and what they favor? What does that tell you about where we are in this cycle?
First of all, looking at customers, I've never done a focus group that I've liked in my life, but what I do is I look. Every company has to surround, and I'm lucky. Well, not lucky. If you don't have the top talent who can answer those questions, then you don't have the right people. We have a vision. We have a vision. My vision is clothes that never expire. They're always taste. They're stylish. Who defines that? Our team does.
What brands excite you right now? And don't say Alex Mill, but take Alex Mill out of the equation. I mean, what brands excite you? Where you look at them and you say they're doing this right, or at least right enough?
Well, if you talk style, first of all, I can't mention brands because then I'll upset some of my friends. There's very few. When I walk into a shop or I walk down the street, what brand? There's some really good ones out there.
Okay, I'll let you off the hook on that. But to kind of build on that question, though, too, with the way people shop, do you think that the standalone retailers, sort of the single brand retailers like an Abercrombie Gap, can compete or are better at merchandising than, say, the multi-line retailers like a Target or in the higher end like a Bloomingdale's?
You give me a name and I'll tell you who's good. Every business has a name, has a founder, and founders, after 10 years or so, or 5, their time is up. Great inventions.
Yeah.
But I don't think, go look at the factory outlets. My good friend Steve Yaloff is CEO of Tanger.
Yeah, we have him on.
He's terrific, Steve, and we worked together for years at Gap. But look at the factory store relationships to their regular price stores. Factory business is a great way for companies to cash, quick, put it on sale. This whole world is a discount world. You look on the 3 major networks and everything's 50 off. It's a game. They used to be illegal, I think, to have these fake high prices.
Yeah.
And now it's all that.
Well, the consumer is trained to look for it. McKee, we appreciate your time. Thank you so much for joining us today.
Thank
McKee
you.
Drexler, the one and only, the merchant prince, the chairman of Alex Mill and former CEO, of course, of J.Crew and Gap. And I was looking at J.Crew, the company he used to run. I don't see any for sale ads on here. I don't see any discounts on the website.
Oh, yeah, I don't know.
Which is unusual.
I have to admit, it's been a long time since I've actually set foot on J.Crew or gone to the store. But, I do go to some of the other brands. I'm more in Ralph Lauren now, something that I've kind of rediscovered. It's not the same as it used to be, but it's good enough.
Oh, you're fancy.
I tried it. Well, I knew McKee was going to be here, so I had to step my game up. So.
Of course.
Ralph's always good.
All right, thank you so much again, McKee. Next up, we're going to take you to the closing bell with Megan Horneman. She is CIO at Verdence Capital Advisors. Keep it right here on The Close. This is Bloomberg.
I think beta is going to be under pressure probably for the next month to 2 months. I think there's more pain to go there. I don't think it's a big problem for the S&P. I think you're going to see more rotation. And we've been urging clients to swap out of beta and towards higher momentum names.
Jeff deGraaf, Chairman and Head of Technical Research at Renaissance Macro, kicking us off to the close. When we started this program, it looked like markets were setting up for one of the worst 2-day declines that we've seen since Liberation Day. Stocks still in the red, Scarlett? But they're actually near session highs.
Yeah, they're paring their losses, and you now see the Nasdaq 100 only down 0.5%. Still, it is the first back-to-back decline in a while, and at one point it was down by more than 1%. So it's been a real change in terms of how things have come off their lows, but the numbers remain the same in terms of direction. Within the S&P equal-weighted index, we're back to unchanged, Romain.
Yeah, unchanged here, and this has been a big question here because people talk about was this really a sell-off, right? And I think yesterday, I don't know if it was you who pointed it out or Tim Senevic, the idea that the majority of the stocks in the S&P were actually in the green, despite the index being in the red. And you saw that play out today. Even when we were at the depths of the sell-off today, you still had a majority of S&P stocks in the green, which suggests this is a little bit more of a rotation rather than a sell-off.
Yeah, but with Jeff deGraaf saying beta is going to remain under pressure, how much of that rotation actually takes place will determine whether we actually move up or kind of stay, treading water at these levels.
Yeah, obviously technicals and the momentum indexes are going to play a big part in that. So too are corporate fundamentals. We're still awaiting some key earnings this week out of names like Walmart, and then next week from several other big retailers, including Macy's. And of course, you have a big Fed speech. Jay Powell set to address Jackson Hole, Wyoming crowd on Friday, where the market hoping that he might telegraph whether rate cuts are indeed on the table for the Fed's mid-September meeting. Megan Horneman joins us right now, the CIO over at Verdence Capital Advisors. And that is where I want to start, Megan. The confluence of all of these events and the idea that while it has certainly maybe rattled the market just a little bit, it has certainly not destroyed it.
Exactly. You can look at the market as a whole. You're seeing some of that weakness there in the technology side and some of those really high PE, very expensive growth type of stocks. You're seeing some of that pullback, but there is some of the other side of the market where you're starting to see some rotation. I think that people are forgetting to mention that there is some rotation into the small caps that did really well last week. And as you can see today, you're seeing that rotation from out of those some of those tech stocks into the more Dow Jones Industrial Average, some of the other names that have been really forgotten here over the past few months.
It gets to the idea, though, Megan, is do you see that rotation or that embrace, I should say, of some of those cyclical, economically sensitive names, the non-big cap names? Is that something that you see as sustainable, or are people just going to rotate back into NVIDIA and Microsoft and everything else once they think the coast is clear?
I think that it's a valuation correction. Let's keep that in mind. Valuations got so elevated here in some of those tech names that I think this can continue for a little bit of time. We've seen this before. It's simple valuation correction. You can't figure out how long that'll take, but it does go on for some time. And if the Fed is going to cut interest rates, whether that's in September or October or in December, then you'll see some of these names you'll see that rotation continue. I think people will move out of those real expensive names, and they'll look at those unloved, small cap. These are great, especially if the interest rates go down and the valuations are so cheap. They'll continue to rotate into international. So unfortunately, I do think this tech valuation correction has some room to go.
Yeah, but what tech has going for it, of course, is that it's growth, and growth, especially in an economy that, like the one we have right now, deserves a bit of a premium. Is there value within growth right now?
I think your big Magnificent Seven, those ones that have really led this, I'd say no. I'd say hold off. I think that you'll get a better opportunity to invest in those. There may be some names that have lagged behind that, but over the long run, even those bigger names, the opportunities are there for the long run, just not today. Wait till that continues to correct. Wait till valuations get a little bit more realistic, and then invest. You can invest back in those, and they'll be something that you hold on to for the long run.
Megan, we also got Fed minutes today that, of course, are dated. They're from 3 weeks ago, and they look somewhat hawkish, indicating that policymakers are more concerned about inflation than the labor market at this point. Does that set us up for some kind of a hawkish surprise on Friday when Jay Powell speaks?
I'm not sure that we're going to get much of a change out of him on Friday. I know Jackson Hole has sometimes in the past been market moving, but I think those minutes, even though they are backward looking, I think they're very important, and I don't think the market's taking into consideration how important that is. The two dissenters are really the only two. The rest of the members talked about inflation, and inflation is still a risk. And even by September, and surely by this Friday, we're not going to have any more additional information from tariffs and what that means for inflation. This is something the Fed's going to have to keep reiterating. So I think they'll do that again when they speak at the Jackson Hole conference, reiterate that the tariff suite is still unknown. It's a lagged effect. We may not feel those effects until the end of this year. So it's going to keep the Fed walking this fine line. I think that they have to really balance that, whether it's this Friday when they mention that or at their next meeting.
I am curious then how that sort of plays into allocations to fixed income, given the uncertainty about the direction of Fed rates, whether they go up, down, or maybe just stay right where they are. When you look at yields right now in the Treasury space, when you look at spreads in the corporate credit space, Megan, do you find anything attractive?
No.
Okay.
Simply no. That's a really easy answer for you. Credit is, that's something I do not understand why the credit continues to grind lower and lower in an environment where the Fed hasn't committed yet to continue to cut interest rates. The futures market wants it, and the president wants it, the White House wants it, everybody wants lower interest rates. But at the end of the day, inflation still is a problem. So when you're going into an environment where the economy is slowing, the Fed may not have the flexibility with interest rates, credit is at risk, especially at these levels, because it's pricing in perfection from economic growth, perfection from the Fed coming in, delivering, saving the day here in September. That simply, I think, is an unrealistic expectation. Also, I think just from, if you look at the Treasury market, I think you'll see some more steepening in the yield curve if they come in and cut interest rates in September. Steepening not just by short-term rates coming down, even though they have come down quite a bit as of late, but long-term rates can rise even when the Fed's cutting rates, because investors are future-looking when they're looking at the economic growth and inflation and what that can do when the Fed starts cutting rates.
All right, Megan, got to leave it there. Megan Horneman, CIO over at Verdence Capital, counting us down to the closing bells. Stocks pairing a good chunk of their losses on the day, but still red across the screen with the exception of the Dow, which is unchanged. Some big drags today coming from big tech.
And I'm looking at volume. Volume in the S&P 500 off 20% from the 3-month average. So that just gives you a sense of, not a whole lot is pushing these indexes up.
Yeah, you do actually have quite a few gainers on the day, just, of course, not the same weighting to lift the whole market. TJX having a great day. So, too, are a lot of the healthcare stocks, including the medical device makers like Medtronic. We count you down to the closing bells with full market coverage of everything that comes now and after the bell with a global simulcast that starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Food, taking you through to that closing bell with a global simulcast. It starts now. Tim Stenovic in the radio booth, Emily Grafeo by his side in for Carol Massar today. Welcome to our audiences across all of our Bloomberg platforms. The second day of declines for the broader market, really a fourth day for the S&P to be clear, 2 days down for the NASDAQ. But the losses on the day, Tim Stenovic, not as severe as where they were just a couple hours ago.
Yeah, it is technically 2 days in a row down, but on Monday, Romaine, it closed only up 1/100% after falling half a percentage point last Friday, and then about 1/10% last Thursday.
You're one of those truthers.
I mean, if you look at the
like
trend
when we
line,
have a 19.99% drawdown, that's not necessarily a bear market.
You don't round that up, right?
Sure.
But you do look at the trend line, and it's certainly been going in one direction for the last 5 trading days.
And we're definitely seeing that the more
except that one day,
the more speculative areas of the market here getting hit the hardest. The Dow is definitely, it's still in the red, set to end the day in the red, but at least it fared the best out of all the major indexes.
Yeah, and it's worth pointing out, yesterday we talked about how the S&P 500, actually the number of gainers and decliners were roughly equal. Today you have more gainers than decliners in the S&P 500, 257 to 246, yet the S&P down 0.3%.
Similar story for the Dow with about 19 names higher on the day. Your Cats, your McDonald's and Coca-Colas. And of course, we've been spending a lot of time today talking about the health of the consumer with a lot of those retail earnings. We're going to get Coty earnings after the bell. Of course, the cosmetics retailer, which comes on the heels of a somewhat dour report earlier this morning from Estee Lauder. Let's walk you through these numbers here because it has been an interesting day to say the least. It takes a while for these numbers to settle, but we're just going to call it right now. The Dow Jones Industrial Average is going to finish the day unchanged, right around that 44,938 level here, despite actually being significantly lower earlier in the session. The S&P 500, which at one point in the day had dropped all the way down to 63.43 and change, closes down at around 63.95 and change, down 16 points or 0.25%. The NASDAQ Composite down 0.7%, and the Russell 2000 down 0.3%. Though I should point out, Tim, the Dow Transports had an awful day, of course, after leading the charge over the last few weeks, down almost 2%.
Well, as far as stocks, the mix of stocks that moved higher and lower, Scarlett giving you a preview, 261 to the upside at the close, 238 to the downside in the S&P 500. So even though, Scarlett, as the S&P 500 fell more stocks in the index did move higher.
And that shows up in the IMAP as well. 7 out of the 11 sectors finished in the green, 4 finishing down. But the ones that did finish down, consumer discretionary, tech, and communication services, they house the Mag 7 names, and they are, of course, the bigger sectors, more heavily weighted sectors. Energy was the best performer, gaining 0.8%, moving higher along with oil prices.
All right, taking a look at the stocks that performed the best in the S&P 500 and in the U.S. today. Well, at the top of the S&P 500, analog devices to the upside of 6.3%. Best performer in a percentage basis in the S&P 500. The company did report results earlier today. Adjusted earnings per share, the forecast for the fourth quarter came in above estimates. The guidance beat the average analyst estimate. The CEO and chair, Vincent Roche, said that, quote, while tariffs and trade fluctuations are creating market uncertainty, demand for analog devices products remains robust. And Hertz also in the green today. Shares climbing after a report that the company will start selling used cars on Amazon Autos, up close to 6% on the day today. This is Amazon Autos' first fleet dealer. Here are some details. Customers can browse Hertz car sales listing on Amazon Autos and finish their purchase online and then pick up their car at Hertz car sales locations. The rollout not all over the U.S. It'll start at Dallas, Houston, L.A., and Seattle. The company plans to expand to Hertz car sales 45 locations nationwide. A reminder that some of these rental car companies are the largest sellers of used cars out there. And Guess shares absolutely surging today. The company going private in a $1.4 billion deal with Authentic Brands Group. It's in partnership with the co-founders Maurice and Paul Marciano and CEO Carlos Alberini. Shares up more than 26% today. Authentic Brands is going to acquire a majority stake in Guess's intellectual property, while Guess Management will continue to run the business and own the operating company. Once again, Guess shares up more than 26%.
All right, and for the decliners, Target was one of those maybe surprising decliners of the day, falling 6%. They had a hotly anticipated earnings report that actually was pretty good. They maintained their guidance, most of the results beating estimates, but the retailer's pick for an internal CEO appointment did seem to offset those better than expected results. So we did see that stock falling over 10% on an intraday basis and then closing the day down over 6%. I'm also watching Estee Lauder. This is the third day of declines for the makeup cosmetics company. Closed the day down about 4%. The company said that it has hired external advisors to conduct a review of the brands it owns, La Mer being one of those, in a bid to accelerate a turnaround after years of sales declines. The CEO said
that's like the little facial serum that costs like $1,000.
Yes, it costs a couple $100s for like a little thing of moisturizer.
I was like, you know what? Maybe there's something that I'm missing out on. I didn't notice a difference.
They never give out samples, ever.
Yeah, you must have purchased.
Well, you know what you can do. You know, you go to Bloomingdale's across the street and use their samples there. You know,
okay.
No, that's gross.
Yeah, everyone's sticking their finger in there.
If you want to save money, you got to think outside the box.
Anyway, for Estee Lauder, the CEO said the company is rethinking its portfolio. Now I'm thinking about moisturizer in order to focus on our highest return opportunities over the medium to long term. We'll share updates in due course. That's from Estee Lauder. So check back in on that company. And then finally, James Hardie. This was a really big drop, worst drop since 2001. The building materials maker falling 34%. They reported net sales that missed analyst expectations, and they also warned of weak demand for repairs and new construction in North America. Really a downbeat outlook here on the U.S. housing market.
Yeah, that was a phenomenal, well, not phenomenal in a bad way, report here. But I mean, we paid a lot of attention to that, and that kind of leads us to this idea of macroeconomic conditions and whether the Fed might actually potentially come to the rescue or whether they even need to. We did get the FOMC minutes a little bit earlier today, and maybe it kind of ratified the idea that, well, rates might not actually go anywhere. In fact, the curve, the Treasury curve today, pretty much steady, right around where it's been. You did see just modest movements to the downside here, but this has been a Treasury market that's been in a bit of a holding pattern. Of course, waiting for Jay Powell's speech on Friday and the official FOMC meeting, which concludes on September 17th.
Okay, you guys were talking about the La Mer, what is it?
Moisturizer.
La Mer moisturizer.
A cream.
Okay. It's the luxury, high-end moisturizer.
But it works, so, you know, it deserves the price tag.
What about a $160 lipstick from the makers of Louis Vuitton? There's a story in the Wall Street Journal.
So I love this question.
Yeah.
I have no idea what lipstick is supposed to cost.
I don't either,
sure,
but this one's
yeah,
scented.
That's expensive.
How much is a lipstick anyway?
I have no idea.
I'm guessing it's less than $160.
That was a shock to you.
Yeah, not $160.
Okay.
Yeah, how much is
That's
it,
the answer.
Emily? Yeah,
No, I mean, you go to a drugstore, you can get a 10, 15, 20.
Okay, well, the folks over at Louis Vuitton actually
does it
think
smell
that
like?
Scented. They think that there is a market at the highest end to create essentially the Louis Vuitton trunk of lipstick. At least that's the question that the Wall Street Journal asks.
But the case that the lipstick is in is also beautiful, right? I mean, it's leather and it's monogrammed and, it looks like one of those mini trunks. So I think that's part of the selling point, too.
Oh, no, Scarlett. The mini trunk costs extra.
Oh.
Do you want to know how much that costs?
No.
$2,900.
Yeah.
Yeah. So.
But you could get a canvas one and an eyeshadow pouch for $530. Okay.
Okay, Tim. I mean,
this is really turning the lipstick indicator on its head. Like, it's supposed to be a recession indicator because it's an inexpensive luxury.
We should just call it the CVS lipstick indicator because that's the one that's going to tell you whether consumers are willing to spend. I mean, so Emily, you brought up earlier about how Estee Lauder is hiring advisors to help it perhaps winnow down his brands. How do they position themselves when you've got Louis Vuitton entering the makeup market now? I mean, what is their highest end brand at Estee Lauder? La Mer, but they don't make lipsticks or anything like that, or regular cosmetics, right? I mean, they're a skin cream company.
Yeah, they just have, I think, that moisturizer that smells really good.
But it gets to this idea, too, of like what the brand power. I mean, we've been talking about this all day today. We had McKee Drexler, of course, famous for helping to sort of build Gap and turn around J.Crew. And this idea of, why would you pay $160 for lipstick? Well, because, it's attached to Louis Vuitton. At the same time, Estee Lauder is dealing with the idea that maybe some people don't see his brand as having that same premium. And that's why when you got their earnings report, they talked a lot about maybe potentially actually scaling back prices or at least offering some sort of discounts. Why are you guys just looking at me right now? Isn't there a flip box or something? I'm confused. It's like I'm talking to myself.
I'm just getting all the information about the luxury skincare
I'm
routines.
just looking at the brand. I mean, Estee Lauder owns an incredible number of brands, right? And the makeup sales that fell 5% during the quarter were due mainly to declines in MAC, Too Faced, and Bobbi Brown. Aveda also saw sales declines. Speaking of another skincare company.
My prerogative,
No, different Bobbi
Tenderoni?
Brown. Yeah, different one.
Oh.
Yeah. Not Mr. Whitney Houston, the ex-Mr. Whitney Houston.
Oh.
Bobby with an I.
Well, now I'm less interested.
Oh, okay.
Bobby with an I.
Thank you, Scarlett.
Yep.
For the information. Appreciate it.
You would know, too, if you listen to 80s pop music.
Sadly, we're going to have to leave it there. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll all be back same time, same place tomorrow.
Stick with us here on The Close. We're going to continue our conversation about the tech sell-off, if you will. We're also going to talk about valuations overall. Brent Thill going to be joining us, the tech sector leader over at Jefferies. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close, and well, it could have been worse. A big sell-off in markets today, extending the sell-off from yesterday. But late in the day, we started to see those dip buyers come in. A NASDAQ 100 that at one point looked like it was going to drop 2% on the day, only closing down about 0.6%. Even some of the more volatile areas of this market, like the SPAC IPO index, like cryptocurrencies, all which had been deep in the red earlier in the session, managed to rebound as we got closer to the 4 p.m. mark here in New York City. Even the VIX, which at one point was touching the 17 mark, closing back below 16 on the day. Now, that doesn't necessarily mean that all the concerns out there are somehow over. There are a lot of concerns out there. Target, of course, down 6% here on the day, the worst day going back to early April. A lot of concerns here about not only consumer spending, but of course some of those idiosyncratic issues with regards to management and its new leader. TJX companies, though, actually bucking that trend, showing that it does have resilience, that low value, that low price model really working to its advantage. Those earnings this morning giving investors some confidence that at least in the retail space, there are at least a couple of companies still worth buying. Meanwhile, in the tech sector, and that's where we want to go back to, we talk about some of those names. Dell, which of course has been just kind of the darling of the AI data center trade, that dropped 5% on the day. And Palantir, the best performing stock in the S&P 500, didn't do so well today, down about 1%, though once again, it was down more than 5% at one point earlier in the session. And that brings us to our top story of the hour, and that's about the jarring nature of this two-day sell-off in U.S. equities. But when you really look under the hood, it's less of a sell-off and maybe a bit more of a rotation. After all, despite the headline index slump, the majority of stocks in the S&P and in the Dow finished in the green again. It's just, of course, that the majority didn't include the heavyweight names that had powered the S&P to a 27% gain over the past 4 months. Using the FTW function on the Bloomberg, you can see the best performing long-only factors today remain low volatility stocks and high dividend payers. Egg producer Cal-Maine up for a second straight day. ExxonMobil up for a third. Lockheed a fourth. AT&T a fifth. And how about this? Health insurer Cigna on an 11-day run. It's an embrace of companies with pricing power and economic buffers, and a bit of a shunning of the unprofitable, the meme stocks like Opendoor and SoundHound, and even a bit of a shunning of some of those high multiple tech names like a Broadcom, a Dell, and well, all 7 of the now not so magnificent 7 stocks. You put it all together, though, and it's not necessarily bullish, but it's not wholesale bearish either. Here's Howard Marks on that point.
It does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells. No reason to think there'll be a correction soon. But the point is that things are expensive.
Howard Marks speaking a little bit earlier on Bloomberg Television. Brent Thill joins us right now here on The Close, tech sector leader of software and internet research at Jefferies. And I really liked Howard Marks' statement because I think he kind of encapsulated the idea that there is some concern in this market, but to use his phrase, nothing really nutty out there. When you look at the sell-off that we've had in big tech stocks, Brent, over the last week or so, is there anything there that gives you a sense that there's something more meaningful there, or is this just a bit of profit taking and maybe a modest rotation into lower multiple areas?
Yeah, I think it's orderly. It's not been violent. Our trading desk has seen, 7 straight down days, very consistent. No one freaking, no one, creating a big havoc. We had the DeepSeek moment. Obviously, many months ago at the beginning of the year, and there's no, concern. There was this MIT white paper about AI not showing maybe the ROI out of the gate. You would expect to see. I think that's a good report. It's kind of what we've been saying is this is going to take years, not months or quarters, for AI to work. Mm-hmm. So I think we're in a little bit of a pit stop. But I would say, talking to our head trader, it's been consistent, stable, very orderly. Part of this could be we're at the end of August, hedge funds have de-risked and degrossed their books. Part of it is, lack of conviction. And part of it is we're waiting for the Fed on Friday and NVIDIA next week. And we'll get those mile markers and then make a move from there.
And that's a good point. I mean, we started off the show today speaking with Jeff deGraaf over at Renaissance. He talked about how this was much more of a technical sell-off rather than one that was really about fundamentals. This idea that there are still long-term themes, particularly with AI, that still have the power to move this market higher. And I want you to take a listen, Brent, to what Dan Ives over at Wedbush told us yesterday.
This is a 1996 moment, not a 1999 or 2000 moment. And that's our view. I mean, this is a tech bull market that will continue to rage on in second half of the year into next year, given we're talking about a fourth industrial revolution.
Brent, so when you cut through everything you were saying in the rhetoric, the general idea seems to be that when you look at the Palantirs and the Microsoft and the NVIDIAs and all of these stocks that have powered this market higher, they didn't necessarily rise necessarily because of a one-to-one fundamental belief. It was more about the structural and longer-term benefits of AI. Are you in that camp?
Yeah, I mean, we've been in the camp. Again, I've been Microsoft's biggest fan forever, and I said Copilot, wasn't a pilot I would fly with out of the gate. Mm-hmm. We've said this, that the product is young, it's early, but we're huge believers that it will become the F-16 or 747 pilot, right? So it's this concept of duration, which is like, that AI suddenly, you're going to open up ChatGPT and create a card or a invite for your kid's birthday, which is awesome. You can do that on ChatGPT. You can't do that in enterprise AI. Like, a lot of the enterprise AI capabilities are just really early, and companies are tiptoeing into them. And this is part of the MIT report, which is like, look, a lot of the deployments, there's confusion. It's hard, that you need better training. You need better data. Mm-hmm. We're going through we're going through this kind of AI fatigue, if you will. Everyone's saying that they have something better, a better mousetrap. Every buyer's holding off. Users are like, look, I've got enough. So we're just in this digestion phase. We are very encouraged about what will happen long term. But again, this is classic of a new technology unveiling. It's just going to take time to acquire, get the taste of it, and use it in the way that is helpful. So none of this is surprising.
Yeah.
And I think it goes back to it's fairly consistent with any new adoption of any new tech. You get excitement. Remember when the BlackBerry came out and everyone's like, I can put my computer on my belt and all of a sudden I can write emails and it was exciting. And then you're like, well, how do you actually scroll the web? You can't on one of those devices. So like we're going through this adoption and it's just going to take time. There's nothing in our line of sight would say that AI is not going to be meaningful in the next couple of years.
And you referenced that MIT report. A lot of people, of course, made hay about it, the idea of this sort of a Gen AI divide. But it gets to this idea that a lot of what they were referencing in there weren't necessarily the larger companies that were actually finding, if not use cases, certainly a case to sell their products to other people. So when you look at NVIDIA, which reports next week, and then, of course, when we get back to the next earnings cycle with the Microsofts and the software and hyperscalers here, do you think you're still going to see that commitment to CapEx to continue spending on AI capabilities?
Yeah, I mean, we just raised CapEx by 40 to 50 billion in the last month when you look at the Q2 number. So everyone's CapEx number went higher across the board. So it's not like Oracle saying CapEx and Amazon, Google, and Microsoft are all down. They're all up. So, this concept of these are the railroad companies, we don't know where the railroad tracks are going. Are the cities going to pop up? Are there going to be enough goods to transport on the tracks? Like this moment everyone is having on AI, which is like all the spend and no ROI. We've said this repeatedly. The backlog of all the hyperscaler and the large tech companies is well in excess of the CapEx numbers. So the ROI is there. Second, Microsoft has said this. The margin is better in AI than it was in cloud. Third, they've just demonstrated 2 years of margin improvement, and they've got the margins flat. But look at the best CFO in software, Amy Hood. Look at one of the best software companies in AI, Microsoft. They just gave you 2 years of margin improvement, and they're giving you huge backlog growth, and they accelerated Azure. Like, how is there not an impact from AI?
I think we're having some issues with Brent's connection. We're going to have to leave it there. Our thanks there to Brent Thill, tech sector leader of software and internet research at Jefferies. And just a reminder, NVIDIA is set to report earnings 1 week from today. When we come back, we focus on the macro with Jay Powell and his trip to Jackson Hole. This is Bloomberg. U.S. economic outlook taking center stage as Fed Chair Jay Powell readies to give his speech at the Economic Symposium in Jackson Hole, Wyoming. The speech coming at a time when producer prices, the wholesale prices, are rising faster than consumer prices, which the team at Bloomberg Intelligence calls a classic red flag that historically signaled weaker profits for companies. And of course, that would translate potentially into weaker economic conditions. Joining us right now is Olu Sonola, head of U.S. economic research at Fitch Ratings. Olu, great to have you here. I do want to start off with inflation. We got the Fed minutes just a couple hours ago, and it does appear that there was a big debate there about putting way more emphasis on inflationary pressures than the labor market. How do you feel about that?
I do think that at the last time the Fed had that meeting, the labor market report came in 2 days later. So to some degree, that meeting was stale, because my guess is if they had the labor market report that came, the tone of that meeting would have been different, and the tone of the minutes that we saw would have been different. I think at this point, the downside risk in the employment market is real, in the labor market is real, and you can't ignore that. Unfortunately for the Fed, inflation is also moving in the wrong direction, right? And you also can't ignore that. So they have to look for a way to square that circle with regards to their next policy move.
When you looked at the disparity between the CPI number we got last week and that PPI number, which shocked a lot of people, what does that say to you about what we should prepare ourselves for?
I think historically, the PPI has been a leading indicator for CPI. So what we're likely to see is goods inflation is going to accelerate. And when you actually look at headline, we have headline inflation going as high as 3.8%.
On
right.
the consumer inflation?
Yes.
Oh, wow.
Headline CPI going as high as 3.8% over the coming months into 2026.
So that doesn't sound like an environment where the Fed would be cutting rates. I mean, even if you do have a weak labor market, where does that, what can Jay Powell say on Friday that maybe gives investors comfort that he can thread that needle?
I think the only leg they have to stand on is to say that we don't think this is persistent. And even you don't.
But didn't we hear that before, just a few years ago?
Exactly.
Right.
It's not not an assertion you can make confidently.
Yeah.
It's very, very uncertain. The trickle, the rollout of the tariffs lends itself to an environment where very likely we'll still be talking about tariffs a year from now.
Yeah.
So that tells me that it may end up being a little bit more persistent than the Fed likes. My guess is that the pace that the market expects, I think that at a point we were pricing in 3 cuts this year. To some degree, it's now 2. That pace is probably not what we're going to see. Even if they cut rates, they will make it clear that it's not an aggressive cutting cycle. They're going to take their time and let the data point them in the direction that's right.
A lot of people, of course, looking at the CPI and inflation data, also looking at the labor market. I think tomorrow we're going to get some PMI data, both on manufacturing and services. Yes. The last report we got, I don't know if it was from ISM or from the S&P, but it was not good on either one. What are you expecting tomorrow?
No, it's the same. Yeah. We're in the middle of an economic slowdown, without question, right? Yes, people point to 3% GDP in the second quarter. If you strip out inventory and you strip out trade distortions, it was essentially less than 1.5, somewhere between 1 and 1.5 for the first half of 2025. We think that trend is going to continue. We have 1.5% growth, GDP growth, for all of 2025, annual growth for 2025. So we think that slowdown will continue. We think you're going to see that in the in the PMI numbers that we're going to see tomorrow.
All right, Olu, we have to leave it there. And of course, those S&P PMI numbers, manufacturing and services, out 9:45 a.m. tomorrow. Olu Sonola, head of U.S. economic research at Fitch Ratings, as we continue here on The Close with a closer look at the state of the economy. With some big retail earnings on deck, we're expecting to hear from Coty. This, of course, is the beauty brand. They are set to report earnings at some point here this hour. We'll bring you those results as soon as we get them and have a broader conversation here about the state of the retail and apparel industries with an eye on the health of the consumer. This is The Close on Bloomberg. Welcome back to The Close. Today we are keeping an eye on the health of the consumer. As we await those earnings out of Coty, the big beauty brand, shares are down in the after-hours trade. Those earnings have not dropped just yet, but of course, the backdrop coming into that was a relatively dour report out of Estee Lauder earlier this morning. Let's bring Jharonne Martis into the conversation. She's Director of Consumer Research over at LSEG. And Jharonne, we've gotten several earnings out of several retailers, and it's been really a mixed bag. Yes. TJX, which always seems to kind of defy any sort of dour expectations, had a pretty good quarter. And then you had Estee Lauder, which just said, look, we're actually going to have to start cutting prices or at least offering discounts to get people back into the store and back onto our website.
That is absolutely true, and mainly because the consumer is all about value right now. They're dealing with high inflation, the unemployment number is going up, so they're concerned about their own job security. The latest consumer confidence data shows. But because of all that, you're saying that they're not opening up their wallets unless they're finding a value. They still want high-end designer clothing, but for less. And that's why TJX is doing so well. There's no stopping the American consumer when it comes to a treasure hunt experience. And so they're able to get like good value and high-end designer for less at those places, whereas they're thinking twice about buying another perfume, buying cosmetics, and that's why we're seeing that companies like Estee Lauder did so poorly today.
Well, speaking of cosmetics, Coty earnings are crossing the wire right now. The bottom line number coming in right now with an adjusted loss per share of about 5 cents, and that is a surprise. The street was actually modeling a profit of about 1.4 cents a share. On the revenue side, they did beat net revenue coming in at $1.25 billion. The street was looking for $1.21 billion, so maybe a testament here to some of the cost pressures on some of these companies and their ability, or in this case, inability, to pass those costs on to the consumer. Gross margin also missing estimates, 62.3%. The street was looking for 63.1%. And we should point out that on a like-for-like basis, sales in the most recent quarter down about 9%. The knee-jerk reaction there in the shares, still on the bottom of your screen there, down about 9%. And Jharonne, this seems to really be maybe potentially the story for this quarter and maybe into next earnings quarter. This idea that you could see a situation where sales actually hold up, but profitability gets hurt because those additional costs, where are they going? Because at least for right now, when I walk into stores, at least for certain items, I'm not seeing huge price increases.
Right. And so what's happened is that a lot of the retailers have been absorbing those costs in order not to hurt demand. But the latest PPI data is telling us that that might be a different story for the second half of the year. PPI, which actually tracks the changes in prices before they hit the consumer, has been rising faster than expected. And now, the retailer has been doing a good job in shielding the consumer because they've been absorbing those prices and ordering a lot of inventory beforehand. But now that will no longer be the case as those prices are continuing to trickle up the chain.
So many of the conference calls we've had, we've heard the executives talk about, if not raising prices, the idea that they certainly have to consider it.
Yes.
Home Depot, P&G, Nike, just to name a few. But it gets to this idea of whether they can, because it's one thing to say we have to pass this on to the consumers, but then you talk about TJ Maxx and you talk about the idea that the consumer is very value oriented. If I start seeing a spike in prices at this store, am I just going to go and sort of look at a TJX or some other maybe off-price retailer and try to find the same thing or something similar?
Absolutely. And we're already seeing that with a lot of the price comparisons. So like when you think about an event like the Prime Week, a lot of the other retailers like Target, Walmart, they're also competing for those prices. And that's also why Target is at a disadvantage, because it can't compete with the likes of Walmart, which is everyday low prices. So unless you're able to provide, really be competitive with Walmart and Amazon, then you're going to lose a lot of that customers.
A dumb question. I mean, how does Walmart do that? Is it just, I was just in a Walmart this weekend, and I was actually shocked at some of the prices I saw. I mean, like significantly lower. And granted, things are skewed because I live in New York City, so everything is really expensive. But it gets to the idea of why do they have that luxury of being able to offer that and others don't?
Because of their size. Because of their size and their relationships with their suppliers that have been for so long. They have that power to exercise that power.
But long term, though, or I should say long term, but over the next few quarters, you still expect tariffs to be a big story, tariff costs.
Absolutely. So when we look at our current forecast for the current quarter, we're looking at a 6.5% earnings growth rate, and that's expected to decline to 1.1 into the third quarter and remain in the low digits for Q4. So this underlines the weakness that we're going to see in the consumer spending in the second half of the year as they are being hit with higher prices than they are now.
Wow. All right. That's great data. Jharonne, always great to have you. Always a pleasure. Jharonne Martis, Director of Consumer Research over at LSEG. And those tariffs, of course, that we're talking about, it's not just the cost of those tariffs, but it's also about kind of the erratic rollout of that policy. It's raised a lot of concerns with a lot of retailers out there saying that they just don't even know how to plan. Our next guest has warned that the Trump administration's aggressive trade approach is really now starting to damage a lot of trust out there, not only with companies domestically, but of course with our trading partners. Pleased to say right now joining us is Manak, Trade Policy Fellow over at the Council on Foreign Relations. And I am curious about this idea of the rollout of these tariffs and the idea that that is giving a lot of folks, a lot of consumers pause, but more importantly, a lot of our trading partners as well.
How these tariffs have been rolled out. It's been very erratic. We've had moments where there's been an announcement for new tariffs and they've been taken away. Then we've had increases over time, threatened increases. So our trading partners don't really know how to plan, but neither do businesses in the United States. When you think about how you plan out your purchases, you're thinking about this in the long term, and you need to have some sort of stability and predictability to make those choices. And right now we just don't have that. So I think the big thing that we're seeing today is, even though we're having a bit of a settling down where we kind of know the tariff rates, there's no guarantee that President Trump is going to keep rates at that place, and otherwise he might just change them too.
Well, it's funny you bring that up. I mean, there was a survey out today that actually showed that, well, at least when it comes to Canada, that 80% of the people, the rank and file people that they surveyed out there, don't actually believe that any trade agreement struck with the United States would actually be honored under this administration. The idea that, yeah, you can strike that deal, you can hold that press conference, but is there going to be followed through? And I have to say, I have no idea whether that's the case with Canada, but we've heard this from other nations very quietly. It's been reported on Bloomberg and on other places that a lot of these leaders are concerned that these agreements may not even matter over the next few months and quarters if the United States doesn't stand firm in what it agreed to.
Well, that's absolutely right. And you think about the case of Canada and Mexico. They are trading partners that already have a trade agreement with us, and that is being violated by the United States. So why would they actually want to sign anything else when the agreement that they had signed with President Trump, by the way, has not been honored by him? So it raises big questions for our allies about what they are going to commit to and whether or not there's going to be a real guarantee that the tariffs won't be changed, even if they make strong commitments. And if you're looking at some of the things that have been agreed to, we don't have things on paper. We don't know what everyone agreed to so far. There have been 10 deals announced and not a lot of text. So we don't know the length of the commitment, when they're going to be implemented, or what exactly everyone is going to do. So it's a lot of uncertainty, and honestly, it's making it really difficult for a lot of countries to sign on to deals.
We've talked a lot on this program about this idea of President Trump kind of, reimagining the new world order, creating a different sort of global trade system. I've been told by a lot of people that's the wrong way to look at it. That if you take the United States out of the equation, we still have a global trade system. You see that in trade flows. That data, the hard data, certainly shows that. Of course, it's just not data that links directly back to the U.S. It's China trying to find deals in Latin America. It's Europe trying to find deals in Asia and in Africa, et cetera, et cetera. Are you seeing the same thing?
Absolutely. And we're looking at the data that's coming out right now. The CEO of Maersk, the shipping company, had said that outside the United States, there continues to be strong demand for trade. And he expects global container market volume to grow between 2 and 4%. So what that's telling us is that the rest of the world is open to trade. It's just the United States that seems to be closing itself off. And when we're thinking about this broader issue of, are you remaking the world trading system? Well, at the end of the day, a single country, even if it's the United States, cannot remake the entire system, because that means not only does it change its relationships with everyone, but it forces those countries to also change their relationships with each other. And right now, every other U.S. trading partner is maintaining the existing rules and playing by those rules and not violating them like the United States is.
Where does this lead us, though, Anu? Let's just be honest. It does not appear the administration is about to change tack anytime soon. They've really sort of made this a hallmark of what they want to be and how they think they can help the U.S. economy and address what they are saying are decades of just say misguided policy, for lack of a better phrase. But where do you see this leading us? And I mean here in the United States, our economy, and whether it actually leads maybe to some potential prosperity, or does it lead to something, I guess, the opposite?
Well, we're going to see, and we're going to see as the impact of those tariffs starts to roll out. In the first few months, what we saw were companies absorbing a lot of those costs, but recent figures suggest that they're passing a lot of those costs on to consumers now. And consumers are sort of responding to that uncertainty. We're seeing consumption dropping among poorer households with cutbacks on discretionary spending like restaurants. And just the top 10% of earners in the United States are now propping up consumption. This could also change. And we're seeing real fears for low growth and high inflation in the future, a stagflation scenario as tariffs begin to bite. So I would imagine that going into the next half of this year, we're going to start seeing those economic impacts. And it's going to mean higher costs, not just for consumers and their bottom line, but for companies that make things here, because half of what we import are intermediate products that we then turn into something else. So this is directly a tax on U.S. manufacturers and innovators in the U.S. economy, and they're going to be hurting pretty soon.
All right, Anu, got to leave it there. Appreciate you coming on with us. Anu Manak, there is the trade policy fellow over at the Council of Foreign Relations, of course, keeping a close eye here on the potential impact of tariffs on the market. Now, we should just point out as we take a look at how markets close on the day, I do just want to revisit Cody just a second. They did just report earnings. Those shares down about 10 to 11% in the after hours trade. And of course, their press release is littered with conversations about the impact of tariffs, saying, quote, that broader macroeconomic and tariff uncertainty is fueling cautious retailer ordering in a more promotional environment. Something to keep an eye on that may determine the next direction for the broader market. This is The Close on Bloomberg. All right, consumers are getting more selective. We know that. We've been talking about it all day. But leisure and entertainment businesses, they're actually hanging on, at least for now. Our next guest company is bracing for how tariffs might impact consumer sentiment. It's forging ahead with an expansion, diversification, if you will, adding water parks, family entertainment to its, well, what was once just a bowling empire. I'm pleased to say joining us right now is the CEO of Lucky Strike, Tom Shannon. Tom, great to have you here on the program. You know, it's so funny, you know, we talk about, you know, you being kind of a bowling giant, but when I start to look at your portfolio, I look at some of the moves that you made. We're talking about a much more diversified business, water parks and other sort of areas of leisure. And I am curious what the rationale behind that was when you started to go down that path.
It's really interesting, Romaine. When we looked at these adjacent businesses, almost by accident, we realized that the economics were virtually the same as bowling in terms of margin, return, and who the customers were. And so we said, these are exactly what we've been doing successfully for almost 29 years now, except they're at a larger scale. So as an example, we now have 5 water parks, and the average unit volume of those is about $17 million versus our average unit volume on the bowling side of about 3.3 million. So for basically the same amount of effort, time, managerial attention, we're doing things with 5 and 6 and 7x the scale. So it's a really exciting adjacency. And the other thing is that it gives us the ability to cross-sell between the bowling, the family entertainment centers, which are branded Boomers, and various water parks that have their own brands.
Well, I am curious that when you talk about the differences between those businesses, what does that spend look like? And I don't necessarily mean in terms of aggregate spending, but like the frequency of spending, the amount that they spend when they actually arrive. Which one typically does better or is more resilient?
I'd say they're both pretty resilient. So if you take the bowling business, there's fundamentally 3 aspects. There are 3 customer groups. There's retail, which is just walk in. There's the league bowler, which is organized play, and they'll commit to a typically 32-week season. And then there's the event business, which is everything from children's birthday parties up to high-end corporate events. And they all act very differently. For example, right now, the league business has been up for the last consistently really since COVID. The retail business has trended positive over the last couple of months, and the corporate business is still a drag. But in aggregate, the bowling business is trending up. The water park business, I think, is sort of a permanent fixture because if you live far from the water, if you're not in a coastal area, you know, and it's 90 degrees all summer, how do you entertain the children? And so we have water parks in the Inland Empire of California, in North Carolina, outside of Illinois, and I think that business is extremely resilient.
When it comes to broader consumer trends out there, we've been talking on this program a lot about tariffs and, of course, the hit that we see on actual physical consumer goods and how that might affect spending. One of the areas that we've seen that continues to be resilient and has been really for several years now, even during the pandemic, was the idea of services. The idea that people may not want to go out and buy a discretionary item, you know, a lipstick or, you know, a new piece of clothing, but they are willing to go out, to go bowling, to go to a restaurant, do things that provide them some satisfaction in the short term. Do you think that holds up, even in the face of any sort of economic downturn that may sort of arise over the next few months and quarters?
I think there's definitely a shift from people consuming things to experiences. And you see that in, for example, the price of hotel rooms around the country. It seems like they've doubled or tripled over the last 5 years. So people are out, they're traveling a lot more. Restaurants, if they're good, tend to be very busy. So I think we're in the sweet spot of the economy. And I don't really see anything changing that. The beauty of where we are is we're very high value. So, you know, the average walk-in retail customer probably spends $35 with us, which is not a lot of money, frankly. And it gives us the ability actually to add products and services like upgrading our food, which we've made a concerted effort to do, and it's actually quite good. Food for us was always an afterthought. Mm-hmm. Now it's a core offering. And I think by doing these things, we have the opportunity to earn more money from the consumer when they visit. But if you had a severe downturn, then people may trade down to us as a higher value offering than going to an expensive restaurant. We've been through 3 major recessions since I started the company back in '97. There was, 9/11, there was the financial crisis and COVID. And what we found was a tremendous amount of resiliency in the retail walk-in business over those eras.
Hey, real quick, Tom, before we let you go, I am curious. I mean, do you have any material tariff exposure that you've been having to manage?
No, we don't.
And you don't anticipate to see anything in that area?
Well, I mean, we have very, very little that we import from China, for example, and it tends to be very low cost and not an important part of our business. So we're sort of, I don't want to say we're immune from tariffs, but we're not exposed to tariffs in any meaningful way.
All right, Tom, got to leave it there. Tom Shannon there is the CEO of Lucky Strike, which has, of course, one of the best tickers on the street, LUCK. And as we talk about, well, experiences and, well, let's just say entertainment, we had the pleasure to catch up with Jeezy, your favorite rapper's favorite rapper. He came back to talk a little bit more about the 20th anniversary of his seminal album, some of his new business ventures, including an energy drink, as well as a capsule collection with Eastside Golf. Here's what he had to say. Take a listen.
Edge is an energy drink, and it's also a mixer for spirits. You know, anybody who likes to drink their nice spirits or whatever, Edge is a great mixer for that, but it's also an energy drink as well. And I'm very excited to announce our partnership with Anheuser-Busch and Eagle Rock, and it's great.
That's a big deal. I mean, starting any sort of consumer products brand, particularly in the food and beverage space, you have to have that shelf space, that shelf visibility, and obviously a partnership with a behemoth like Eagle Rock, Anheuser-Busch. I mean, how did that come about? I mean, was it pretty easy to convince them to come on board?
Well, no, it was one of those things where we all sat out in the room and really just talked about the vision, and we were all on the same page. Everybody was aligned, and Anheuser-Busch, you know how they're thing within themselves, but also Eagle Rock, and starting and base it out of Georgia, and just work our way from there. And you know, I've had experience with spirits before, from Avion Tequila, obviously, to Nod. But this is our new thing, and I'm very excited about this.
It's a non-alcoholic beverage,
absolutely.
But you are promoting it as something
a mixer
that can
as well.
be used as a mixer. Is that the primary focus, or do you want people mainly just?
I think a little bit of both, because I think that everybody needs an edge. You know, you need an edge when you're making your spirits, and you need your edge while you're getting some energy. So it goes twofold for me, for sure.
Yeah. Well, one of my producers, she just slams Celsius at her desk all day long. But it gets to the point. There's a lot of competition in this space, and I am curious as to how you want to stand out, because when I think energy drinks, you think Monster and Celsius, and obviously you've had new entrants in, like obviously with the Paul brothers, and then a lot of other folks as well. So how are you going to stand out in that?
Our marketing for sure is great. I love our package and I love our marketing, but our product, like, I don't get behind or get involved with things that I don't consume or deal with as a lifestyle. You know what I'm saying? And for me, it's like, the sugar content is low. The taste is amazing. There's no aftertaste, and it's refreshing to drink. So it's not like when you drink those energy drinks when you feel like you're drinking an energy drink. This is something that you probably would drink, just on a Saturday evening, hanging out at the crib.
The sugar content's low. That's for health reasons.
Yes. I mean, as far as me, I definitely practice and preach a healthy lifestyle, and we actually had a conversation about the sugar content. I hadn't bring it down, and they was open to that. So I was definitely, pleased that they understood that I didn't want to be out here selling things or getting behind things that wasn't going to be healthy for people.
So we're going to see this on store shelves. We're going to see presumably in
store
bars
shelves,
as well.
The whole thing,
in nightclubs. All right. So you're doing a lot there, and that's just getting started. That launches in September.
Yes.
In addition to that, and of course your tour that you're doing for the Thug Motivation anniversary, you also have a capsule collection of clothing with a company called Eastside Golf.
Eastside Golf. Yeah. So golf is my thing. I'm working on my handicap now. Let you know how that goes.
How long have you been golfing?
About 2.5.
Okay, so you just got into it.
Yeah, about 2.5.
Was that just why? Is there a reason?
It was. I actually went out and went out with some of my mentors and was blown away about how much peace was out there and how much just tranquility and just being able to be in a space where you could have these dope conversations with people you respect and learn about them as they learn about you. And then I started actually getting some business done out there, and I'm like, this is my thing. So I love golf. All my guys, I definitely introduced them to the game as far as like, just come out here and check it out. And they all fell for it, loves it. And we golf all the time now.
And for our viewers who aren't familiar with Eastside Golf, this is a black-owned apparel company. It has an edge to it, if you will, the idea that it's not sort of the staid, old-school golf clothes.
It came from, well, first of all, we're making golf cool. We're making golf culture because I think that it deserves that. And we want to look good while we're out there, while we're having fun. So Eastside Golf is a black established golf clothing company. And we actually partnered with the owner, was a great colleague of mine. And it came out of the east side of Atlanta. And he's actually a golf pro. So it's a big thing. It's a big deal if you're ever in the South, or if you're ever in Detroit, anywhere where they really wear it, like you'll see it as if it's a staple in the community when it comes to golf.
And
so we've partnered.
And we've seen a big expansion in the world of golf, where you're seeing more people who look like us involved in that sport. I mean, obviously you can go all the way back to Tiger Woods, and he obviously brought a lot of people. But now I think about the brands that have been Eastside Golf, Trap Golf, and quite a few others that have sort of entered this space as well. How far do you think we can take this? Does this become something that is primarily for your people, your culture, or do you see it broadening out beyond that?
I think it broadening out beyond that. I've seen kids from all different walks of different walks of life wearing Eastside Golf. I mean, and actually know what it is. So I definitely respect that. They've partnered with everybody from Jordan to Mercedes-Benz, and now Jeezy. You know what I'm saying? So we're doing the Jeezy Eastside Golf collaboration, and it's bringing the Snowman logo to golf.
Okay, yeah.
So the Snowman is golfing now. Imagine that. You know what I mean?
And that was part of my conversation with rapper and entrepreneur Jeezy. That was part of it. If you go over to Bloomberg.com, you can watch the full interview. We talked a lot about golf. We talked a lot about energy drinks. And of course, we talked a lot about his current tour and some of the troubles he's had in getting to the tour. Shout out there to the Uber driver, Tanner. All right, let's take a look at the after-hours trade here. We should point out that despite the big sell-off, futures right now are indicating a slightly basically flat open. We'll see how that sort of plays out as we get into the morning cash session. And, of course, keeping an eye on some of the retailers, those Cody earnings, that stock down about 10% in the after-hours trade. We're going to get some big earnings in the morning here. Walmart is going to provide us a nice read here on the health of consumer. Of course, they have a lot of pricing power, and we'll probably hear a great deal about what's going on with regards to tariffs and costs. We're also going to hear from Ross Stores after the market closes, as well as two software companies, Intuit and Workday, set to report earnings. We'll have full coverage of that here on the close. But don't forget, quite a bit of economic data to parse as well. Weekly jobless claims, monthly S&P Global PMIs, as well as the leading index and existing home sales. And of course, all eyes on the Jackson Hole Economic Policy Symposium, which officially kicks off tomorrow. We'll have full coverage of that right here on the close, right here on Bloomberg.